Assalamu alaikum, everyone. Am I audible? Can you hear me?
Yes, I can.
Okay, great. Great. So, welcome to Market Talks with Musaffa, your weekly deep dive into halal investing, where faith meets finance. We are on a mission to halalify the investment world, one stock at a time, inshallah. So, today's topic is the quarter two earnings season and the tech sector. Basically, the quarter two earnings season is giving investors a lot to think about. The big tech continues to report strong earnings, but at the same time, the companies are spending hundreds of billions on AI infrastructure, and investors are starting to look beyond the headline EPS numbers. Today, we are going to look at what is really happening underneath the earnings number, whether the AI spending can actually deliver the returns investors expect, and what the latest results from companies like Meta, Microsoft, Amazon, Alphabet, and Apple are telling us. We are joined again by Brother Ali Merchant, CMT, a seasoned financial market professional and market analyst who has prepared a detailed analysis for the quarter two earnings season and the Magnificent Seven for you guys. Before we start, I'll briefly mention a short disclaimer that we have. So, Musaffa LLC is a US SEC registered investment advisor, and registration doesn't imply endorsement. This session is for informational purposes only and should not be considered an investment advice or a recommendation to buy or sell any securities. The discussion is not tailored to your individual financial situation. Please do your own research or consult a qualified advisor before making any investment decisions. The views, opinions expressed during this webinar are our own and may not be representative of the views or experiences of the others. All investments involve risk, including potential loss of principal. Past performance doesn't guarantee future results. Okay, guys. If you can hear me, if whoever is in the chat, please you can type wherever you are from, so that we know. It's very important for us. And then basically we can start probably, Brother Ali.
Sure, I'm ready.
The stage is yours.
Yeah, thank you very much. Assalamu alaikum, all everybody. Thank you very much for giving me this opportunity, and we can now start sharing the presentation. All right, guys. So, first of all, again, thank you very much for all joining. Thank you very much for Musaffa to bring me up here. Now, I'll tell you the reason for this topic which I have selected today. Now, we have seen Q2 earnings almost, I would say 60% of S&P companies have already reported, and a couple of more companies needs to report. Now, if you guys remember what happened until last year, all these large tech companies, they had, the boom in AI has created intensive, expansion, intensive spending, and capex, right? So that's why I have selected this topic, and I'll give you one of the examples that if you remember Oracle. Last year, Oracle was somewhere around, early this year, last year, Oracle was around $400. Last year theme was the higher the capex, the higher the stock price goes. Now the theme has changed. So let's go through the presentation and I'll give you all the highlights of what we are going to cover. So now basically, this is what we are going to cover, from earning per share to AI-driven matrix, right? How markets are rethinking value. Meta's billion-dollar gamble. Can massive AI investment overcome its compute crunch? Microsoft's AI edge. Proven cloud revenue and Copilot users justify hyperscaler capex strategy. So some of them, they had wonderful earning, excellent earning, but the future guidance and capex was higher, so they got beaten by the market, by the investor. And some of them has seen the result of whatever the capital expenditures they have done in the past, right? Chip makers windfall. We'll talk about it, how hyperscalers AI capex squeeze benefits semiconductor giants. Amazon cloud momentum eases AI spending, concerns AWS growth accelerates. How the Magnificent Seven have performed over the last 12 years, and Apple AI problem. So their weak guidance and all. So we'll go through it, right? Let me go through the next slide. So the Key takeaway from what has happened: why earning season and cash flow why the AI impact on earning season cash flow focus, right? So EPS reliability is eroding, right? So earlier we used to look at the EPS, and EPS used to drive the market, right? AI capital driven AI driven capital spending is exposing limitation of earning per share metrics, which rely on discretionary accounting treatments that management can manipulate to meet guidance. Cash flow is becoming the truer measure of corporate health, right? That is first thing. Big tech AI, big tech asset-light models obsolete. So former giants like Google, Meta, Microsoft are transforming into capital-intensive hyperscaler, investing hundreds of billions in infrastructure, making traditional EPS comparison increasingly meaningless. Right? Alphabet's warning signal. Despite record earnings, 112 billion of earning and EPS beat, Google reported negative cash flow, negative free cash flow. And that negative free cash flow theme came after Oracle. And we have seen that the infrastructure and the leverage funds got sold off in March this year. So Google reported negative free cash flow for the first time in its public history, signaling that accounting profit can mask deteriorating, sorry, it's a tongue twister, operational reality and investor concerns about capex sustainability. Shift to cash flow matrix. So from earning matrix, we are moving into cash flow matrix. Investors are pivoting. Investors are pivoting towards free cash flow, revenue growth, and tangible operational results rather than massage it quarterly EPS, reducing management's ability to engineer beats through the accounting adjustment alone. Right? Accounting gimmicks persist. While AI is disrupting the EPS obsession game, the broader problem of creative accounting practices remains. Companies will simply adapt their manipulation tactics to new metrics requiring continued investor vigilance. So that's why I have selected this topic. Right? So Alphabet reported best earnings, but with negative free cash flow for the first time. Let's move to the second one, to the third slide. This is what Alphabet is. So if you see this chart from Q2 2025, their free cash flow was positive. Here, here, and then Q4 2025, Q1 2026, Q2 2026, free cash flow has dropped into negative. Alphabet's 444.92 billion capex reality check. Google's capital spending exceeded Wall Street consensus by 770 million, and management guidance signals sustained elevated capex for years ahead. The market's 7% stock price decline on earning day proved that cash flow now matters far more than EPS beats, making a fundamental shift in how investors value big tech. Right, guys? So let's move. Cash is king in the AI era. So Wall Street reckoning with real money versus accounting fiction. Right? Free cash flow tells the real story. Unlike earning per share, which companies can tweak through accounting tricks, free cash flow shows actual money flowing in and out. It's harder to fake, making it a more honest picture of a company's true financial health. That is first thing. Depreciation of shell game. Big tech companies are changing how fast they write. So big tech companies are changing how fast they write off the cost of servers and equipment. Google, Microsoft, Meta, and Amazon have all extended the useful life of their server, how long they assume equipment lasts, which reduces yearly depreciation charges and artificially inflates profits on paper. Right? Moving to goalpost. For example, Alphabet extended server life from 4 years to 6 years into 2023. Microsoft and Meta made similar moves. Excuse me. These changes do not reflect actual improvement. They are accounting decisions, and they are accounting decisions that make earnings look better without any real business improvement happening. Right? The auditor problem. Company hire and fire accountant who approve these depreciation decisions, creating a conflict of interest. When a company owns, when companies own hired auditors rubber stamp questionable accounting choices, investors should be skeptical. Cash flow wins. Investor finally caught on. Alphabet beat earning expectation but reported negative cash flow and massive AI spending of almost 45 billion. So the stock dropped 7%. The message is clear. Real cash matter than manipulated earning numbers. So that is the key. So let's get into the next slide. One second, guys. Okay. So free cash. So now, Meta's billion-dollar gamble. Can massive AI investment overcome its compute crunch? Free cash flow signals unsustainable spending. Meta free cash flow plummeted about 91% year over year to just 784 million in Q2, driven by massive compute infrastructure investment. The 9% pre-market stock decline the day they announced the earnings shows investors are alarmed by the company's ability to fund operations and growth while backrolling on its AI ambitions. Right? Cash flow versus competitive position trade-off. Meta faces an impossible choice: lease access compute capacity to enterprise customer, solving its cash crunch, or preserve all computing resources for internal AI development, risking competitors' dominance in the enterprise AI market. Now, the other thing is playing catch up in enterprise AI. Unlike Microsoft, Google, and Amazon, with established enterprise relationship and hybrid AI offering, Meta is trying to pivot from consumer ad tech to compete in the lucrative enterprise AI space, a market where it has minimal presence credibility. So credibility check. The long-term viability question. With free cash flow nearly depleted and no clear timeline for compute return over on investment, ROI, investor must assess whether Meta's AI infrastructure bet will eventually generate sufficient enterprise revenue to justify the billions in current capex, or if it's a costly strategic miscalculation. So we have to consider, right? Their strategy is changing, and it can be a costly strategic miscalculation. Right? Let's go into the next one. Let's look at what is Meta competing with. Spending like a AI cloud giant, Meta's risky bet to transform into an enterprise AI powerhouse. You can see that free cash flow has dropped. So Meta Q1 to 2024, Q2, Q4, then Q5, Q1 2025, and then Q2. It's gone 91%, right? And with the expenses are going higher. So vague monetization. Zuckerberg offered no specific on pricing, adoption rates, or timelines for AI products. Investors are betting on undefined future opportunities rather than evaluated this business models, right? So these are the three critical risks where it comes to Meta. Unproven demand bet. Meta is building data center capacity, betting AI demand which materialize later. Unlike AWS, Amazon, Azure, which is Microsoft, Google Cloud with proven revenue streams, Meta consumers and enterprise adoption remains unproven so far. Right? Ads revenue dependency. So their dependency is on ads, right? So every AI infrastructure dollar depends on Facebook and Instagram and sorry, one second. Every AI infrastructure dollar depends on Facebook, Instagram, and ad revenue. If AI monetization fails, Meta has no alternate revenue engine to sustain the capex spending. Right? So that is another flag, right, for the Meta. All right. Now let's go to Microsoft. Microsoft's AI Edge, proven cloud revenue. So they have proven cloud revenue, and Copilot users justify hyperscaler capex strategy. Now Microsoft, after the earnings, their stock jumped, though overall their cash flow. So Microsoft AI return on investment blueprint, right? Now, Microsoft started capex spending last year, large capex spending, and it was dropped. Right now, free cash flow down 23%, stock up 8%. Microsoft proved that capex-fueled AI bets can deliver immediate shareholder value when backed with proven cloud revenue. Right, so they beat the Amazon Azure beats, right, and real product adoption, Copilot usage. Its massive corporate customer base and early AI positioning provide a clear monetization path that competitors like Meta lacks. Right now, Microsoft stock has gone higher, and Microsoft stock in the last week has made all-time high. Right, so it was, I think, the previous high was 455. I think it went up to 400 and, if I'm not wrong, 490 plus. So that's the thing. So there, what is happening is, if you have a capex, so Microsoft allocated a lot of capex in Q3 2025 or Q4 2025, and the stock tanked. Now they got the result of their bet on AI. Right. So let's go. 1 second. Okay, let me go to 1 second, guys. All right. So Microsoft Azure Search proves the AI infrastructure bet is paying off finally, right? So look at this graph, cloud revenue from Q1 2025, it dropped in Q2, and now it is up about 45%. Analysts were expecting a jump, so that's what has happened in the result. Right, it's like 2027, right? Right. Accounting illusion,
Yes.
not reality. Microsoft stretched data center lease. So Microsoft stretched data center lease recognition from 15 to 25 years, right? Creating the appearance of low capex guidance, $50 billion versus $56 billion, and analysts estimate, without reducing actual spending. The accounting change masked the true acceleration in capital outlays, right? So basically, their capital expenditure has gone higher. Capex acceleration marks free cash flow decline. Despite lower reported capex guidance, Microsoft's actual Q2 spending jumped 70% year over year to 41 billion. Free cash flow of 19.6 billion beat estimate but fell 23% annually, revealing the strain of 700 billion in big tech capex on cash generation. The accounting shell game continues, like Meta, Google before. So like Meta and Google before, even Microsoft, with proven Azure revenue, it is using depreciation accounting to manage the investor perception of capex levels. The real story: capex is accelerating faster than revenue growth can offset it. Right, guys? So let me move 1 second to the next slide. Okay. Now, when capex catches up, data center glut could flip the script on AI profitability. Right at the moment, earning growth takes off. So what the market is this was if you see the orange line, this is the estimated trend of earnings, while the EPS has growth parabolic. So EPS is growing parabolic. Right? So S&P 500 earnings are at record highs, 60% above trend. So this is the trend. This is above 60%. With sustained growth projected for years, nearly all this premium is attributed to AI-driven optimism and inflated expectations. The data center reckoning. If questionable AI data center economics underperform, the earning boom evaporates and stock revert to historical valuation, crystallizing major losses for investors riding the AI wave. Now, this is the expectation. Now, again, guys, this is not any investment recommendation. This is what the expectation is, and it's for the education purpose. So if AI data center economics underperform, then we will come back to the so the earnings boom evaporates and stock reverts to historical valuation. At the moment, its stock is at the highest valuation, right? So that is one of the challenges. Now, in this whole scenario, what actually has happened? Actually, what has happened is the spending of hyperscaler is the benefit for the semiconductor giants, right? That's what we can see. they spend. So basically, they're spending hyperscaler their free cash flow. So they're basically what is it? So hyperscalers capex squeezes benefit for the semiconductors. So semiconductor companies are benefiting from their spending. Capital intensity kills margin. Massive AI capex transform hyperscalers from capital efficient to capital intensive business. Now, 2 years before, or once we, so the AI boom has actually come in the end of November 2020, 2022, when the Chat GPT came in. If you go compare the price of Nvidia stock at that time, and then you see the parabolic rise in Nvidia, you'll see the difference. Now, what has happened is they used to be these all Max 7 used to be full of cash, right? They used to have surplus cash, right? Now with the AI investment and this AI run, they are allocating a lot of capex, and their competitive advantage is losing as the margin compress, execution risk rises, right? Now, I remember that CEO of Nvidia said a couple of, I exactly don't remember where exactly, but a couple of weeks ago, that to to basically create 1 gigabyte, 1 gig data center, it used to cost about 10 to 20 billion. Now the cost has gone higher to, it will go higher to 80 to 100 billion. So once the costs go higher, the profits will squeeze. And most of the AI projects in European market, 92% are still in the making. They're still not ready. Right? Fragmented value chain. Hyperscaler compete with chip makers, NVIDIA, LLM developers like OpenAI and Anthropic, and each other. No single player controls the AI stake, fragmenting profit and reducing pricing power. So that is another challenge. LLM dependency. Long-term agreements with third-party LLM developers limit hyperscalers' ability to capture full AI economics and create dependence on external innovation. So those are the one. But somebody's spending is somebody's benefit. That's what this chart is showing. That the semiconductor companies are making money, and hyperscalers are losing a little bit of their edge. Right? Okay. One second. One second. This is the same slide, or okay? I think sorry, I have duplicated the slide. So it's the same. We just spoke about it when capex catches up with our data center glut. Could flip the script on AI profitability, right? So let's say, as I mentioned, that S&P 60%. So S&P earnings are at record high, 60% above trend, with sustained growth projected for years. Nearly all of the premium is attributed to AI-driven optimism and inflated expectation, right? And you see what is basically the expectation, the trend on the EPS, and what is the way we are seeing the difference, about 60% above the trend. There's somebody there. Can you go on mute, please? So can everybody please go on mute, because I can see somebody in the background. Okay, let's say. All right. So Amazon stock has gone higher. Okay. Amazon Cloud, Amazon Cloud momentum eases AI spending concern. So Amazon Cloud momentum eases AI spending concern after their um, earnings, right? As AWS growth accelerates, right? So you can see cloud revenue validates capex. Amazon's strongest AWS growth in 4+ years, 37% Q2 jump, and 220 billion capex plan signals AI investments are generating major returns. Potential 340 billion market value shows investor reward proven monetization, right? The monetization divide. Microsoft 43% cloud growth, and Amazon AWS surge prove capex ROI. So those who allocated capex in the past and they are seeing returns, market has appreciated and market investor has liked their stocks has gone higher after the earnings, right? The monetization divide, Microsoft 43% cloud growth, Amazon, AWS surge, prove capex return on investment when tied to immediate revenue. So immediate revenue. Meta and other face investor penalty when AI spending lack clear near-term monetization pathways. So they have the monetization, they're monetizing Microsoft and Amazon, while Meta and others are facing, they don't have a clear path or they don't have a clear monetization path, right? AI spending fatigue setting up. Big tech 730 plus billion annual capex is approaching investor tolerance limit, right? The, the market increasingly distinguishes between hyperscaler with proven cloud revenue like Microsoft and Amazon and those betting on speculative AI trades like Meta. So clearly you have the understanding of what's happening in the Max 7 and in the AI sector, and especially those who have got large capex and which is not complemented by the revenue, right? And those who have large capex and don't have the plans how they're going to generate the revenue, right? Let's go. Okay. Now, Apple AI problem. Weak guidance trigger 500 billion market capitalization decline in Apple. So Apple was at 52 weeks high the day of the earnings. I think it was if right. So it was at 50. I don't remember exactly what number it was, but it was higher. And then the after the earnings, it dropped. So AI capex starves Apple of chips. Now with the hyperscaler data spending, Apple has a problem to source the chips. So hyperscaler data center spending strains global supply chain. Apple struggles to secure memory chips and processors despite legendary supply chain management, signaling industry-wide wide component scarcity. Inventory buffer gone. Apple stockpile is depleted and memory costs surging. Unable to absorb price increase, the company cannot meet strong iPhone Mac demand, a rare constraint for Apple's scale. Weak AI story hurts growth. Q3 guidance 9 to 11% trail Wall Street 12% estimate. Lacking of compelling Apple intelligence narrative. So lack of compelling Apple intelligence narrative undermines premium pricing power and investor confidence in sustained demand. So you can see that from here. Apple forward PE ratio. So these are the Max 7. Tesla has the highest and Apple is the second highest. Right? And then you can see Alphabet and then we have Microsoft. The lowest is Meta. Right, guys? Now towards the final slide and then we get into Q&A session. How Magnificent 7 have performed over past 12 months. Now this is basically all values are rebased to zero. So you can see Amazon, Apple, Alphabet, Tesla, Meta. The highest is basically Alphabet. It declined from May to date. And if you see the green one, Apple has gone higher because all except Apple, everybody has a large capex on AI infrastructure and AI data centers. Apple didn't have a lot of AI allocated capex. And then you can see Tesla has dropped. And then you can see Nvidia and Microsoft. Right? Amazon is picking up. Microsoft is here. Amazon is this. And those Tesla is at the bottom. And then we have this is Amazon. And then which one? This is Nvidia. And this is Apple. And this is Alphabet. So that's all from my side, guys. And we are open to Q&A.
Thank you, Brother Ali. That was an amazing presentation. So we can probably start with a couple of questions. During the presentation, I have prepared a couple of questions for you. So we have from your presentation, we have understood that EPS doesn't provide a full story, and the cash flow is becoming more important. So we understood these points. The question I wanted to ask is, the big tech is spending hundreds of billions on AI right now, At
Yes.
what point do you think spending this much becomes a risk rather than an opportunity?
It all depends on how they can justify the revenue. CapEx is one part of it, but like, see what happened in this earning season. Those like Microsoft started spending on CapEx last year,
Mhm.
second half of last year, and it we have seen in their cloud revenue. So Microsoft got the benefit out of it. Same thing Amazon. Now the others, those who did not catch up on the revenue side and keep on streaming up their capex, they've been beaten by the market. So it all depends on how quickly it's going to be. They realize the revenue on it. The other thing is AI is now becoming a very capital intensive game, right? So as I said that NVIDIA CEO said somewhere that it 1 gig AI data center used to cost about 10 to 20 billion. Now it's going to cost between 80 billion. So the profit realization will take some time. But having said that, AI is a paradigm shift, right? So like what happened in the 1910 and 1920, we had a shift from to industrialization and automobile, right? Ford industrialization, that was an
Yes.
era. Then in 80s we had the era of computers, and then in we had e-commerce, and in early 2000 we had e-commerce and .com, era of e-commerce and .com. Now we are in the era, and then we had a era of big data, and now the utilization of big data, which is AI, fast processing. Right? So that's the thing. So this is the paradigm shift, and it will take some time. And that saying that, yes, investor will be very concerned on free cash flow versus earning per share. So let's keep an eye on how the revenue stream in their next earning comes out.
Mhm. Yes, exactly. Coming back to the discussion we had about Meta.
Right.
So right now, from your presentation, Meta is spending heavily on AI without
Yes,
clear monetization path. So, do you think
exactly.
is what Meta is doing is essentially betting that AI demand will catch up with the infrastructure it's building?
Now, if, in the case of Meta's main revenue comes from the advertisements, right?
Hmm.
Okay, let me go to the
Yes,
slide. Let me see. Right. Okay. Now it's going into an area which is not the strongest area, which is
exactly.
the cloud computing and sharing AI compute, right? So they have no proven track record, right? Now what they will do? They will earn from the ad and they will spend on the AI. So it's a very risky. They are on the risky path, but let's see how they beat the other cloud services.
Hmm. Yeah, and following up on that, so
Right,
unlike Meta, Microsoft looks a bit different. So
right,
their already existing product Azure is already generating strong revenue, and Copilot is being adapted. So is
exactly.
that what we can call a successful AI investment story?
See, Microsoft has actually, yes. So Microsoft started now in the case of Meta is going into a different business sector. So initially, it was spending a lot on AI for their Instagram and Facebook related
Yes.
ads and everything, and then they are shifting the gears, right? Where in the case of was in the cloud business, and they started heavily investing in cloud late last year to mid last year. I mean, second half of last year, and they got the result after a year. So sometimes it's a game of patience. Right?
Hmm.
So their strategy proved out to be result oriented. When it comes into Meta, they're going into a new space. So they already have three competitors to compete with: Microsoft, what do you call it? Microsoft, Amazon, and Alphabet,
Amazon,
right?
Google, yeah.
Yeah, Google. So all these are in the cloud space, right? So Microsoft is opening a new channel, which could be risky. Sorry, Meta is opening a new channel, which could be a little bit risky. But if I go back if we see in the past, those who have taken the risk, I mean, luck favors risk takers, right? So those who have taken the
Yes.
risk and they have changed their direction as per the result they got it, they've been successful.
Yes. Yes. So shifting a conversation a little bit. So we talked about Microsoft, Amazon, Meta, and Google,
Right.
but the companies building the chips and infrastructure are also benefiting. Do
Yes.
you think the semiconductor companies like potentially the bigger winners from this AI spending cycle?
Now, we see we have a herd mentality as a human being, right? So we see
Exactly.
some profits. I mean, we can get any sector which is profiting, everybody starts investing. So now this big chips company like Taiwan Semiconductor,
Hmm.
Nvidia, AMD, they are getting a lot of competition. Recently, we get what is name? What is it? Hynix, SK Hynix. SK Hynix, the Korean company, is investing a lot. And then more semiconductor companies, like there's one company from China, CXMT or CMXT. They came into pre-IPO, the highest IPO in China. So the
Hmm.
competition will increase. Now, what will happen is the AI customers are limited. Hyperscalers are limited. When more semiconductor comes into play, then what will happen? Everybody will take the shares. Now, that's what we have seen in NVIDIA. NVIDIA used to have about 83 to 87% of the market hyperscaler share, but then AMD was about, I think, 5% or 6%, and then we have Broadcom. Eventually, so NVIDIA probably is going to lose their market share because the market customer base is not increasing, but producers are increasing. Right? So what will happen is the same thing will happen that eventually, if I'm into a new AI company and I need chips, I'll go to probably somewhere else where I can find cheaper chips.
Yes,
So there
exactly.
will be some distribution from larger producer to smaller producer. And
Hmm.
again, the AI market is not chip hungry. So it's not the capacity or the type of chip which you're using. It's more software hungry. That's what we have seen in DeepSeek. That's what we have seen in Alibaba. And then there's another company, Kimi or Kiwi, something with China, with the
Yes.
new AI models. So these are also coming into AI. So this market will be highly competitive going forward.
Yes. Yes. And uh, finally, for our Muslim and Sharia conscious investors, what do you think are two or three numbers or signals that you would watch most closely in the next earnings season before deciding whether a big tech company is really delivering
Well, the
or
first thing,
simply spending on promise of AI?
okay. So basically, yes, we have to keep a focus on what their AI spending versus what their revenue stream is, how they are
Mhm.
converting their spending into revenue and what they are going to do it. The other thing is, last time when I was on this forum, I think it was in April, and I showed the guys that since 1939 until today, S&P has gone higher. Now, any drop in the market, we have to keep a focus of a long-term investor. If we are going for a short term, medium term, probably there is a possibility that we have to be very vigilant in our investment strategies. But if we are going for the long term, market has gone higher, I would say 90% of the time. Like
Hmm.
we have seen a lot of what do you call it recessions. I mean, since 1939 till today, we have seen multiple recessions. We have seen wars. We have seen a lot of issues globally, but the market keeps on rising. So any correction on the downside, if you are a long-term investor, look for select the right companies, Sharia-based investment. Start into the habit of investing. Somehow, I have noticed that we do not have the habit of investing.
Hmm.
So we have to start
Yeah.
be vigilant, start looking at it, start investing. Now, this, as I mentioned, this AI phenomena is a paradigm shift. There are many sectors which are like still in the process of adapting AI. So there means more room to come. Yes, there will be volatility in the market, but investing for the long term will be a prudent approach.
Exactly. Yeah. So I believe the big takeaways seem to be that investors shouldn't just ask, did the company beat earnings? They should also be asking where the cash is going and when is that spending actually going to produce a return, and focus more on a long-term horizon of investments.
Exactly. Exactly.
Yes,
I
great.
mean, this time at this time, like markets are at all-time high.
Mhm.
We are getting into the midterm election. Now, historically, midterm election, August, September, October are generally range trade market. I mean, high volatility, but it remains in the range. We have seen new highs in the indices last week. Probably we're getting into a market which will remain in a lot of volatility and range trade.
Hmm.
But generally, historically, what I've seen is after the midterm, market moves higher from November to March next year. That is
Hmm.
what historical patterns are suggesting based on a midterm election year.
Got it. Got it. Yeah. Yeah, I believe we can finish at this note. Thank you, Brother
Sure.
Ali, for this great
Thank you very much.
presentation and for this great discussion. And thank you, everyone, for joining this weekly Musaffa calls. And please continue joining us weekly on the calls. And inshallah, we'll be coming up with more amazing presentations and discussions for you guys.
Mohammed, can I add
Thank you,
something
everyone.
to the
Yes,
Mohammed,
of
can I
course.
add something to our attendees?
Sure, sure.
Guys, please note that we have started on Musaffa Academy. We have started earnings previews and earnings reviews. We have done a couple of them. Like recently, we have done on I think Apple, QCOM. So please do visit, look at those. We're going to have some good announcement and good. We're going to add more content over a period of time. Thank you very much for your time. I appreciate your time.
Yes. Thank you, guys.